Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we have Edward Chancellor joining us. How you doing today, Edward?
Fine, thanks.
Great. Well, I wanted to bring Edward on the show this week because I just read an excellent book, The Price of Time, The Real Story of Interest, and wanted to bring Edward on to talk. It was a great historical context of interest rates and some great stories that we can learn from history. And given all that's going on in the world, I thought I couldn't find a more excellent guest to talk about it than him. So, Edward, welcome to the show.
Well, that's a nice introduction you've given me.
high bar to jump over. So, so Edward, maybe you could tell us a little bit about your background. I know I've read some of your prior works, but maybe for the listeners who have not, maybe you could tell us a little bit about your background.
Well, I started in finance about 30 years ago, working in the City of London for an investment bank, Lazard's. But I actually quit that after a couple of years to actually start writing about finance and in particular financial history. And that led to publication of a book called Devil Take the Hindmost, History of Financial Speculation, that came out during the dot-com bubble, end of the dot-com bubble in 1999. And then, since then I worked as a financial journalist, as a consultant for hedge funds, and also at the investment firm GMO in Boston, sort of large institutional investment firm, founded by Jeremy Grantham. And I worked with Jeremy's team for about 8 years in Boston. I've edited a couple of books that are quite well known in the investment world on the so-called capital cycle theory of investment, which sort of looks at advises investors to look not so much at trying to forecast demand in any of the industries where they're investing, but actually just look at supply conditions. And that and the latest book I published on that was called Capital Returns. It came out in, I think, 2015 or 2016. And then most recently, I've been working on the book that you mentioned, A History of Interest, not of interest rates. You see, there is a very good history of interest rates by Sidney Homer and Richard Siller. This is really a history of interest to try and understand, when did interest originate? What did interest, how did it fare over the years? Why? What are the various functions that interest rates do? And what are their consequences of low interest rates? And the aim of of this book, from a historical perspective, was to try and answer the question that seemed to be most pressing over the course of last decade and into this decade, is why were these interest rates in the US and Europe and the rest of the world so low, and what consequences were these extremely low interest rates having, and what was likely to be the upshot of all that? So it's both, I suppose the book is sort of 40% historical analysis and 60% sort of contemporaneous, and really also includes within it a history of a sort of financial history post the global financial crisis. And my idea was, in 50 years' time, when someone wants to know what happened after the financial crisis, this might be one of the books that they would go to.
Yeah, so it seems like your timing is impeccable. You wrote the Devil Take the Hindmost in '99, and you wrote this book that came out earlier this year. I'd say your timing is great.
Well, look, it takes a long. You could say both these books have sort of bearish. Like, obviously, you're writing a history of financial speculation during one of the great speculative manias of all times. It's bound to be sort of bearish, yeah. And as you know, well, as you probably know, sort of bearish ideas often take, a long time to be realized. They often say that the bull market doesn't end until the last bear has capitulated, and in a way, you could, it takes so long to write a book. That's sort of roughly the equivalent amount of time it takes for a bear to capitulate. So, and that's, likewise in this, what we've just seen now. I mean, the year, 2020 COVID mania was the worst year for bears, to stock market bears, people who were selling short, I think, in all history. I think of all those guys shorting the meme stocks like GameStop and AMC, was AMC Entertainment. That's these meme stock squeezes. So the bears pretty much capitulated by last year, which upon which that's always quite a good time if you're lucky for the book be coming out.
Yeah, it's interesting. I mean, last year, or 2020, what should have been considered risk actually turned into volatility. When the market, which should have been down a lot more, ends up 10% for the year. It was a crazy time indeed. I want to talk a little bit about history, because what we're seeing now, like I said, your timing was impeccable in that we had really low interest rates for a really extended period of time, and all of a sudden now rates are skyrocketing in a historical sense. And I wanted to look at kind of history a little bit, because what we're seeing now, most people think, well, let's put it this way. I've seen people talk about how this is unprecedented, but yet I don't think it is. So what we're seeing now, what are some time periods in the past that have had a similar kind of reaction to low rates?
Well, first of all, I'd say that this is, in some ways, I think it is unprecedented what we've lived through, because we've got 5 millennia of interest rate history. And with the exception, during the Second World War, the Treasury kept short-term interest rates down at artificially low level, and pegged long-term interest rates down very low. I think they're roughly 25 basis points on the short term. But with the exception of the war period, US interest rates never fallen to zero. And in Europe and Japan, they went less than zero. And that really is a unique phenomenon. And then if you think about it, we had some $18 trillion worth of bonds worldwide trading at negative interest rates, yields. That's never been seen. So they're very unprecedented. However, there are periods of low interest rates, or when interest rates have fallen quite steeply, sometimes often known as easy money. And one of the points I make in the book is that the periods of easy money, of ultra easy money, coincide with the periods of the great speculative bubbles. We have a tendency nowadays to think of speculative bubbles as either induced by investors' sort of flawed psychological makeup, or we sometimes think the bubble is to do with a new technology and an investor sort of making some sort of mistake about how quickly that technology is going to establish itself. And those ideas are not completely invalid, but what I'm trying to draw particular attention to in this book is that the really most speculative bubbles, particularly ones that cover entire markets, let alone ones that we've seen recently covering all markets all over the globe, that those type of bubbles, most bubbles tend to have a monetary underpinning. You find the great bubbles occurring at times of easy money, and and as far as I can see, we don't have a huge amount of data on interest rates in Holland in the 1630s when the Dutch tulip mania came about. But it's clear that the Dutch interest rates have been falling pretty rapidly in the early 17th century. It's also interesting that foreign capital had been coming into Holland because the Dutch had established a bank. Some people call it central bank. It was called the Wiezel Bank, that took gold and issued notes in exchange, and people and merchants found these notes very convenient. So you see a massive increase of capital inflows into Holland, and presumably a growth of the money supply, and that coincides with the famous Dutch tulip mania of 1636, 37, and then if you go on towards the end of the 17th century, 1690s, there was a great, the first great stock market bubble in Britain, in the city of London. Actually, the sort of focus of attention was technological. It was on sort of diving bells, but again, it was a period of monetary discombobulation, of falling interest rates and so on. Then 1719, and we can talk about this in slightly more detail. John Law in France, and Mississippi bubble. That was the time when interest rates were falling, and then followed by the South Sea bubble in England of 1720, and then frankly right through to the 2020 everything bubble. You find these periods of low rates and speculative bubbles. I have a chapter in the book about John Law and the Mississippi bubble, and the reason I devote a whole chapter to it is that this period was to my mind, very instructive to what we were going through in recent years. Namely, so John Law was a Scottish gambler. He'd actually sort of killed a man in a duel in London in 1694, and then fled the country, having been condemned to death. He's actually a brilliant gambler with a brilliant head for figures. He goes around the sort of various capitals of Europe, amasses a gambling fortune, and also develops a sort of interest in economics and monetary theory. And he settles in France in the second decade of the 18th century, and he persuades the French regent who's governing France to allow him to set up a bank, and then he sets up a central bank, and he sets up a company that we call the Mississippi Company. And the idea of John Law was that France needed to get down interest rates, and the best way to get down interest rates was for the central bank to print a lot of paper money, get rid of the gold money, because that limits the amount of money you can issue, and have a paper money. The Mississippi Company actually sort of agrees to take over all the French debt, national debt, and exchanging them for shares. And in effect, the money printed by the central bank is used to buy up the Mississippi Company shares. So it really is what I say, it's the world's first experiment with quantitative easing. And then what happens? Interest rates come down from around 8% to around 2% by late 1719, 1720. Now, 2% becomes the capitalization rate or discount rate applied to the valuation of assets. So, house prices go up in France, and then the most of all is that the Mississippi Company, John Law's Mississippi Company, which is this huge trading company. It incorporates a huge, aside from the national debt, a huge number of different activities, and including the Louisiana Company, which laid claim to half the territorial mass of the current United States, and that company, the shares in that company went to a price earnings ratio of 50 times, and it sort of paid out all its profits in dividends. So the dividend yield was 2%. And what Law was saying at the time is the valuation of this company is justified by the low interest rates. Well, he brought the interest rates down And then he pushed up his company, the share price company, which went up 20 times in the space of a few months. And he said, hey, hang on, so this is fine. The interest rates are low. And then, of course, you want to pay a PE of 50 on this stock. Then, so that's what, and then you get, huge amount of money is made. This is the word millionaire, French word, is coined at this time. And France, Paris is thronged with millionaires, and they're all going out and buying, sort of gold carriages and living the high life. And law, and this is a tremendous prosperity, and Law is fated as the greatest man in Europe, and by his own reckoning, is the richest man who ever lived. A position recently taken by Jeff Bezos, who was then subsequently usurped by Elon Musk. So that tells you something, doesn't it? That Mississippi bubble produces the world's richest man. Everything bubble produces the world's richest men in history, but not just one of them, but two of them. Anyhow, so that everything's going swimmingly, and then things go wrong. The money that Law has created, which initially is just used for buying other shares, like quantitative easing was just used for buying bonds, it then finds its way into the economy, and you get a massive surge of inflation, and then people start losing confidence in the paper money, and we have a new the French contribute another new word to the financial vocabulary, which is to realize your profits, réaliser. So people start realizing their profits, and the French currency starts collapsing on the foreign exchange, and then law is in a tricky position. You've got this inflation, the share price of Mississippi companies coming down, people are angry, and Law has to decide, do I deflate, withdraw the money I've created from circulation, or do I continue with the inflation? And I think probably to Law's credit, he decides to deflate, but that is the end of his, of his scheme. The company's shares crash, and Law actually is forced to flee the country at the end of 1720, leaving his wife and daughter behind, and his entire fortune. So from the richest man to, I'm not saying the poorest man, but the man who's lost his fortune in very quick time. So that's another warning for the likes of Elon Musk, that these bubble fortunes are made very quickly, but they can go. And I think to my mind, one of the most interesting things writing about this period is coming across what the contemporary academic, economists, monetary policy makers think about this whole episode. And they say, they're extraordinarily blithe about it. They say, notwithstanding Law's failure, his theory provides the role model for modern central banking. Well, I mean, the experience was one of high inflation followed by financial collapse. So I think those are to my mind, the most salient story, aspects of the story to take away. But some or other our modern economists are so sort of theoretically indoctrinated that they don't really see the bad actual side of Law scheme. They only just see the beauty of a world in which a central banker can create money, buy stocks, manipulate interest. So that's what they take from Law. I take a completely different story. I'm notwithstanding the fact that I actually quite like Law as a person, but I think the system was a catastrophe.
Well, so it's interesting because I appreciate the story. I think that's a good segue here into applications currently. So you have this bubble that he's created, which very much like the bubble we've just created, and then you have the choice of whether you continue to inflate or allow deflation. So how do you think the central bankers now look at that, and why are they so afraid of deflation?
Um, well, I mean, I argue in the book that central bankers and contemporary economists, uh, on the whole, make too much fuss about deflation, because normal deflation comes about when companies improve their products and reduce their prices. And one of the reasons that interest rates moved lower and lower was actually we were having quite a lot of normal deflation from the mid or disinflation from the mid 1990s onwards. That due to globalization and technological improvements, and central banks kept rates down for that reason. The trouble about that policy is it when you cut interest rates, you tend to, everything else being equal, you tend to encourage growth of leverage. One definition of interest is the cost of leverage, or the price of leverage. So if you cut the price of leverage, you're going to get more leverage. Now, if a banking system or financial system is in a state of over leverage, of excess leverage, then when things start to collapse, people will start to pay back their debts. And when they pay back their debts in a sort of with a modern banking system, money ceases to be created and the money supply contracts. And as the money supply contracts, prices come down, deflation, inverted commas. As you get that deflation, then people find their assets are now worth less, even though they paid off their debt. So they then have to pay more of their debt off. You get more. So you get this. In theory, you get this downward spiral, and so that's why, in a nutshell, why central bankers are worried about deflation. The trouble is that their policies of lowering rates prior to the crisis leads to high debt levels that then brings about the risk of debt deflation. We saw that, if you remember, back in the global financial crisis, subprime crisis, when you've got a burst of the bank crisis, banks were folding, and there were fears of deflation setting in, which became the rationale for the ultra low interest rates of the last decade. But we've ended up, I'm not saying the world is exactly the same as it was in 2007-8, but we've ended up with more debts in aggregate globally, and corporate debt in particular has grown higher. Government debt is much higher. So central banks are somewhat they're caught between a rock and a hard place, because they want to raise interest rates to bring inflation under control, and to, in other words, to sort of to both to sort of restrict demand in the economy, but also to discourage people from borrowing. But on the other hand, they risk bringing down the financial system. And although rates have picked up, very quickly this year, in absolute terms, they're still not at very high levels. And relative to inflation, they're running at very low. The interest rates in the US and Europe, in real terms, if you subtract inflation, are heavily negative. So they talk a lot about tightening, but at the same time, I think that they are extremely conscious of the risk of rising rates too quickly and bringing down the financial system.
So that brings up an interesting question, one that I've been thinking about. If I had to ask Chairman Powell one question, it would be, if you're cornered, right? If you're put in a position where the economy is in recession, or at least stagnation at the very best, and inflation's still high, do you keep raising rates in the face of a recession, or do you go easy on it and risk, eventually hyperinflation? So how do you kind of take that that kind of quandary that the Fed's in, and how do you think they'll react?
Well, I don't think keeping rates low, I mean, not hiking into recession, even if inflation were quite high, would be exactly a hyperinflationary risk. I think there is a risk, and I don't, I can't tell you, quantify it in terms of probability, but there is a risk that the US hedge fund manager Paul Singer alerted to in a letter to investors recently that was cited in the Financial Times. And Singer's relating, as far as I remember, to the fact that the Bank of England came in recently to calm the markets after a crash in the UK government bond markets, gilt markets. And the Bank of England was had announced that it was, raising rates and was going to be engaged in quantitative tightening of actually selling the bonds it held on its balance sheet. And within 4 days of that announcement, the bank came back and said, actually, hang on a sec, we've got the gilts market is crashing, the pension funds are going bust. Here, we're going to throw some, we're going to go in and throw some money at it. And Singer was saying, well, if there's a huge amount of fragility in the system as a consequence of these ultra low rates, and let's just take it, the crash in the gilts market was just one symptom of it. And you've got this, $600 to $800 trillion derivatives market, of which 2/3 are interest rate related. So you don't quite know how much, of those contracts are formed around the notion that interest rates were going to remain close to zero for a long period of time. But if there are very big problems there, and the central banks go in time and time again and print money, to, so to speak, to buy securities to calm the market, the danger is that they could undermine confidence in the currency. So I think go back to your original question. So that's the sort of high inflation, hyperinflation argument. The high, moderately high inflation for longer argument is simply that there's so much debt out there. There is no way that the central bank is going to tolerate deflation. There's no way that anyone's going to pay off that debt. And the easiest way to pay off the debt is to allow inflation to run moderately hot for quite a long period of time. And we call that financial repression, the keeping interest rates well below the level of inflation. So when everyone says, go back to earlier, when everyone says interest rates, sorry, I'm going to get rid of this. When everyone says interest rates are very high this year, it's actually a very acute financial repression. So the historian, comes back and looks at 2022, will say, gosh, how the central banks kept interest rates well below the level of inflation in order to pay off the debt. So financial repression is here and is here today. And frankly, I think it will continue. And so, Jay Powell, I think, or anyone who replaces him, will, on the whole, tend to keep monetary conditions easy. I think for me, that would be the base case scenario. And then you can get other scenarios around that, like, your deflationary bust. That's also quite conceivable.
So you think, because I've spoken to a lot of, bond fund managers, and I haven't spoken to a single one who thinks that that the expected bond yields, which certainly, the Fed funds rate, the expectations are going to keep increasing. Initially, it was up until January. Now it's up to June or July. And not one of them thinks that the market is accurately pricing in what the Fed needs to do, which to me is going to be an interesting outcome, because obviously the markets price in future expectations. So what do you think the goal, I don't mean specifically, but in general, the thinking, where do they need to be with the Fed funds rate compared to what the rate of inflation is in order to kind of moderate, the challenges ahead of inflation increasing?
I don't. I mean, I have to say, I find the actual nuances of the implementation of monetary policy almost impossible.
Yeah, fair.
My brain is not big enough to compute all the information needed to know how to set the interest rates and to understand the fragilities of the system and the robustness or otherwise. If you look back at earlier periods of inflation, people have argued, and I think it's probably true, but I'm not 100% sure. People have argued that short-term rates, Fed fund policy rates, have to be above trailing inflation, and that was certainly the case. When you got to the Volcker era of 79 to 81, 82, when monetary policy was kept very tight. So that was, I think, you need very high rates to squeeze it out of the system. You need rates that are positive in real terms. Which put that way doesn't sound very high. The trouble today, and this is where this time I think is different. In finance we always told you, never say this time is different. We've seen it all before. And only complete idiots who never opened a history book say this time is different. But actually, as I'm trying to chronicle in the book, you've got a huge amount of risk taking, leverage, inflated asset valuations, problems in pension markets. You've got these sort of problems with the misallocation of capital. You've got these sort of bubbles in crypto, or all over the shop, and it won't take very much to bring that structure down. So I think, frankly, go back to the rock and the hard place, the monetary policy needed to, if there was an appetite, political appetite really, to really restrain inflation, would probably be higher than the financial system would be able to withstand. And so you would, I think fair to say, you would usher in a financial crisis that would be much more severe than the global financial crisis that we went through 13 years ago. So I do, my own view is that central bankers probably won't do it, but you can never be sure.
Well, right, yeah, you certainly never be sure what's feasible or what they'll end up doing. I think and this brings up the question of the 1970s period, where that was a period where certainly the details were a little different, but similar enough that I think it's instructive for how to look at the situation now, because they went through a similar thing, right? Where interest rates, they couldn't beat inflation, in part because of politics. There was no political will to stamp it out quickly. Correct?
Yeah, and I think I also think that the central bankers in the 1970s were sort of in denial, at least initially, of the connection between money supply growth and inflation. They didn't subscribe to sort of Milton Friedman's monetary theory of inflation, and you see that the central bankers likewise they don't really believe in it. That's why they're completely blindsided by the inflation. They printed all the money in the lockdowns, and then expanded US money supply by 30%, and then suddenly you get inflation and you go, wow, I wasn't expecting that. Well, every man on the street was expecting it. So I think that I think the similarity is, as you say, there was little political will, because although people complain about the cost of living crisis, they don't want their, the value of their houses to come down. We see that particularly in the UK, where our mortgages are short-term rates, so the pick up, so it's not just people buying new houses as in the States who feel the impact of rising interest rates. It's like everybody with a mortgage starts to feel it. So basically, people they won't suffer, they won't tolerate higher rates, even if those higher rates are needed to kill inflation, because they don't want to see their house prices fall by 30%.
So how does that differ from Japan? I mean, the stock market dropped for 22 years, and certainly they've had deflation for an extended period of time. I can't say exactly how long, but
yeah,
long
they
enough.
haven't. To be fair, Japanese haven't really had. They've had sort of the mildest decline in house price in the consumer prices. Never, as far as I know, exceeding 1% a year. I think in Japan, this sort of mild deflation environment has rather suited the elderly aging population, who sits on piles of bonds and cash, and they don't want that to blow up. But I don't know, to some extent, I've done a lot of work on Japan, but one often sort of comes to the conclusion when you finish Japan work, as the Japanese themselves like to say, Japan is different. And it's a bit of an outlier at the moment, certainly this year, with still no inflation to speak of, and still actually continuing with its rather extreme monetary policy, yield curve control and so forth.
I mean, their currency is certainly not holding up very well, but
yeah, not very good for my Japan investments. But I like to think when you're investing in the stock market, the currency movements are entirely of a temporary nature. We'll see about that.
So I guess getting back to the 70s, though, because I think eventually we did kind of whip inflation, much to the dismay of the politicians at the time. And certainly Volcker stood up and said, we need to do this, more or less.
No, look, to be fair, Volcker was appointed by President Carter. And I think he was appointed because there was a political will to crush inflation. But actually, Carter, in effect, sacrificed his own presidency because he was a one-term president, relatively rare in the US. So Carter, sort of in a way, you could say he sacrificed his career by appointing Volcker to bring down inflation. A pretty heroic thing to do, really.
Yeah, I mean, I would say, right now the inflation that we have now, I guess you could say, is largely attributed to the supply chain and deglobalization problems.
Well, look, inflation, multifaceted phenomenon. So
of course,
you could have, you can talk about it from a monetary perspective. You can talk about it as supply. You can talk about it by demand. You can talk about it demographically. What we seem to be in is a situation where there were a number of forces holding together to keep inflation under control, and almost, they almost all reverse simultaneously to create, if you will, a sort of perfect inflation storm.
Right, but there's multiple factors. Printing of money and low interest rates for a long period of time. We had, close to 20 years of printing money that did not lead to inflation.
Yeah,
right. It wasn't only till after COVID that we actually started to see it.
Yes, and we didn't get, as I outlined in the book, we didn't get consumer price inflation. We got a hell of a lot of asset price inflation.
Correct.
And you could say that the quantitative easing in its early stages remained, so to speak, trapped in the financial system. So you've got, inflation of, you did get inflation of, contemporary art prices, or the value of, or, supercars, or other luxury goods. Yeah, it's just the rich got a lot richer, and other people, sort of weren't getting any richer, and the money wasn't in their pockets. It was only with the sort of stimulus checks and so on that the money actually ended up in people's pockets. And then you got that was more your helicopter money inflation that Ben Bernanke, Fed chairman, talked first about, I think, in 2002, so 20 years ago.
So, one thing that kind of comes to mind, because we can obviously speculate about the will of politicians or the lack thereof, but one thing that kind of comes to mind is real estate right now, which is, largely dependent upon the rate of interest in terms of the price and the affordability. So I don't know if you have kind of maybe in a historical context you can bring in. I think you mentioned it with John Law with the bubble after with real estate, but we've seen a huge run up in real estate prices, and now you can afford half as much of a mortgage than you could last year. So I guess maybe there's some historical context you can bring for how that kind of squares that circle when interest rates start to rise.
Yeah, I mean, the great real estate bubbles. I mean, look, real estate is a long-dated asset that delivers its service in terms of rent, if you will, and income over many years, and therefore real estate is particularly sensitive to changes in interest rates. And I think again, going back to my earlier point, all the great real estate bubbles coincide with times of interest rate being low, and then the busts tend to come back when rates rise. And I suppose the best known the best known real estate bubble of all time is Japan's real estate bubble of the 1980s, second half of the 80s, where it ends with the grounds of the Emperor's Palace in Tokyo, which I think about 26 acres, I may have it wrong, were valued at more than the entire real estate of California. Anyhow, so that was a pretty big real estate bubble, and Japanese interest rates were low in the second half of the 1980s, well below the level of economic growth, and then I think they went up very quickly in 89 into 90 to about 5.5%. Then you got this protracted multi-decade real estate bust. And I think in the UK and Scandinavia at the time, also in the late 80s, you had housing bubbles that burst. You had a Nordic banking crisis. In the UK, we had quite a severe downturn. In the US, you had the S&L crisis sort of in the late 1980s. So that was sort of linked to the tightening of interest rates globally. And now, I mean, funny enough, I actually don't think the US is in the worst position. I think, as I mentioned earlier, countries like Britain and Australia, where the mortgage market's funded in the short term, they're much more sensitive to rising interest rates. Australian market seems to come down. Canada, seems to be extraordinarily vulnerable. It's done. I've seen a lot of analysis in recent years that suggested that Canada was sort of following the Canadian real estate and monetary policy was quite similar to what US was before the global financial crisis. So I think Canada is important. So I think, yes, I think US hasn't had as much overbuilding as it did prior to the global financial crisis, and we don't have we don't have the securitized subprime debt there. So I think it's problematic, for the US, but all those people who've locked into their short-term rates at the end of last year, which I hope all your listeners did, then they in a way, if you think of it, they're great beneficiaries because they locked in to cheap financing. That's what you want to do. Yeah, the value of your house, in marketing, it might come down, but if you're not planning to leave, move out in the next 6 or 7 years, you'll probably actually end up better off with this inflation having locked into these low rates.
So one
actually quite positive.
Yeah, I mean, one final question I want to ask you in the interest of time. I know you got to run in a few minutes, but I wanted to ask. I mean, you gave an example of John Law and the inflation that took place, and a few examples. If you look at the tulip bubble and a few others, those are very regionalized inflation events. But now we have global inflation, more or less. In many of the developed world, and I can't say for each one, but Turkey, I think, is 180% inflation rate of inflation. There's a lot more inflation than there has been. So I guess the question I would ask is there a historical example where that has happened globally, and what happened in that situation?
Well, actually, I mean, going back, to your 1970s, that was, as far as I know, that was the first. I mean, maybe some of your listeners will know otherwise. As far as I know, that's the first period of sustained global inflation. And so, yeah, we do, in that sense, we're back then. And I suppose what we haven't mentioned about the 70s was also a period of energy crisis. And we are, we are in a period of energy crisis. That looks like it's not really just to do with Russia, with Russia and the Ukraine and the problems with cutting off supply of natural gas from Russia. It's actually there's been very little investment in traditional hydrocarbons in recent years. So we'll have, I think, ongoing very we'll have periods of ongoing tight energy squeezes or crises, and those are pretty inflationary, because one definition of inflation is a rising cost of energy, and there's nothing actually that a central banker can really do about that. You can, what the Fed did in the 1970s is they accommodated the increase in energy prices with a loose monetary policy. But the alternative would have been, if you put in tight money, then you'd have had pretty heavy recession, economic downturn. So you can sort of understand they get blamed for the outcome, but people don't often think about what the counterfactual is.
Yeah, people don't typically look at what's missing. They look at what is.
Yeah.
Well, Edward, I really appreciate you coming on the show and sharing your wisdom with us, and highly recommend the book for all the listeners. Where can people find more about you and some of your works?
Well, I've got a website, edwardchancellor.com, and that lists the various books I've done and the articles I've written. I write for Reuters Breaking Views, which is the commentary service on Reuters. And I list also my podcast things on the website. So that's the best place to go.
Great. Well, I will put that in the show notes for all the listeners who want to learn more about Edward and his books and his podcast. You can go to the website. And well, Edward, really appreciate you having on the show, and always love your writings. Big fan of your work. So thank you again for joining us.
Great pleasure. Enjoyed that.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Edward. Really appreciate him coming on the show. Always like getting people with a good grasp of history on the show. I think everybody's got an opinion, but when you talk to historians, it's a little bit different take, which I find fascinating. Some people might not like it, but I love it. So I wanted to bring him on the show to really educate people on what's happened. But now we're into the panel portion of the show. So this week we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing today?
Doing great. Glad to have you on. And we also have our very own Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing? I'm going to try to manage that mic a little better today. But yeah, no, I thought it was really interesting. I'm looking forward to talking about it today.
Good. Well, I think we're all coming off turkey coma from just after Thanksgiving. I think we're all going to be sharp because it's middle of the week. But Megan, what were some of your takeaways from the interview?
Yeah, I mean, first of all, I really enjoyed this interview. I like financial history. I like learning it. And also, from an advisor perspective, right, when you are working with clients, I see myself as a storyteller, right? And, Mark Twain said, history doesn't repeat, it merely rhymes. So when you're working with clients in these really challenging, volatile markets, you're really focused on providing context to keep them engaged and invested, right? And so financial history is really, really valuable in helping clients understand, as we are in a bear market, it hasn't officially been called a recession yet. You often talk about things like what has happened previously in these types of markets. What is the history there? And I will tell you, it's really important when you are doing this type of storytelling with clients and using history is from a thematic standpoint, it's not just having a story on what is going on historically today with the US, but also, what is going on in Europe, what is going on in Asia, what is going on globally. And I think if you're able to keep sort of clients engaged in what is going on, what are the data points, what are we looking back on, you can really get them to understand that they're part of a bigger picture. And I think going back to the interview, that's what made the interview so interesting, right? He was able to weave these stories into the bigger picture and give context.
Yeah, no, I totally agree. I think the value of history is definitely the fact that, things repeat and, getting context for what happened is usually missing in most of the mainstream media. They usually just throw out a data point and they draw a conclusion for you. So Doug, what were some of your takeaways?
Well, I think the key here is that there's a lot of noise that people hear, talking heads. They get caught up in the moments. They get caught up what they see. It kind of takes me back to watching sports, right? So Monday comes out, everybody's got their reaction of what they saw, and they see it from one perspective. They're sitting on the couch, the beer in hand, watch the game and say, I know everything about football, right? Well, you get the game film and you actually listen to people that watch the game film, and what you see on the NBC broadcast is very different than what's actually going on the field when you get the coach's film. The coach's film shows everything. It's like, that the offense was great. Well, actually, wait. Now you see the coach's film, you realize the receivers weren't getting open. They weren't they weren't pushing off. They weren't blocking. Missed mistakes here. Again, there's a lot more detail, and a lot of the noise that we hear that you get from little snippets on the news, little snippets on talking heads, the Kramers of the world, you got to ignore that, because when it comes down to it, the bigger picture is how things are functioning together and all the little details that go into it. And I love it because I was reading some of Chancellor's some articles that he's written, and the great bull markets are, he wrote this on October 6th. Great bull markets are propelled by a dominant belief that of a new era of permanent prosperity, of exciting new technology, and so on. Bear markets occur when that belief is proven wrong. Well, think of what we have seen in the last 14 years, right? We have seen a bunch of people that have looked at the bull market, with a beer in hand on their couch, watching the game, saying, see, it's a new era, permanent prosperity, exciting new technology. Everything's changed. This time it's going to be different. He talked about that in the podcast, right? But it's not. If you go back on history, he talked about numerous things that have occurred before, that are occurring again. But every time we get out of those moments, people forget. And then the noise comes in, and you get little people that just take snippets. See, this is going to go on forever. See, housing is all supply and demand. We need houses, so that's why housing prices are going up. No, a small minority of people have been saying this for years. Housing prices are going up because interest rates were so low that more and more people could get money, hence higher demand against that limited supply. But now, pop the bubble, and all of a sudden that demand drops. Oh, wait, what we've seen before is happening again. What a shocker.
Well, I think you just raised an interesting point, Doug, which I want to kind of frame here, is that, most people talk about higher interest rates, and they talk about, well, there's still high demand. And it's like, well, no, first of all, the demand's dropped off. We show this on the show like almost every week about how demand's dropping off. But I think there's this myth out there for a long time. It said, well, we still have a huge amount of demand in the market for real estate. It's like, well, no, there's rentals and purchases. The housing stock has not changed all that much. But, the demand is largely because, hey, if I can afford 2 houses or 3, why not buy 2 or 3? Because interest rates are so low. So I think that's a great perspective. One of the things we brought on, Edward, which I think it's good context for a lot of the conversations we've been having for like the last year about inflation, interest rates, and bring in some history is really important. But obviously we have to take some practical advice for takeaways here, because, just learning about history is great. But how does learning about history like this, Megan, impact what people can kind of take away from this and apply to their own lives?
Yeah. So, I think one of the things that's been interesting in this marketplace right now, and I know, Doug, you and Kirk will agree 100%, is cash has become an asset class again, right? It's really, really exciting in a lot of ways, but it's also a point to give clients context, right? Because, and it's interesting because there's a lot of 20-somethings in my office, and I have to give them the history of what happened to money markets back in 07, 08, 09 when they broke the buck, right? So giving history, so it's exciting that cash is an asset class, but it's also, okay, well, now that it is again, what are our investable options, right? Obviously there's savings accounts, there's money market accounts, there's, for high net worth, they build their own cash management accounts using treasuries and agencies. So what are the options out there? What is a money market, right? Because that's what a lot of clients are drawn to and is available for them. And then what are the histories with money markets, right? What are our risks, and how have those risks played out previously? And since Barb's not here, I do want to give a definition of money market, which is a money market really basically involves the purchase and sale of large volumes of very short-term debt products that are overnight reserves, commercial paper, right? And as rates have been rising, that commercial paper, reserves, agency bonds, US Treasuries have had an increase in their interest rates. And so that's how we're able to pick up yield. And so I think it's really important when you are deciding even to put your cash to work in a money market, do a deeper dive. And if you go on sites like Morningstar, Schwab, Fidelity, all of those sites can allow you to do the deeper dive and understand what are you actually investing in to give you peace of mind. And history allows us to assess the pros and cons. So, you know, it's funny, every meeting I'm doing today, you know, there's thematically, we're talking about the fact that everything in the market that's true today was not true a year ago, right? Cash is an asset class. Fixed income is actually paying income now. And equities are actually at reasonable valuations. So, you know, the whole market is sort of turning on its head, and that's okay. That's normal. And you can look at history, and over time, we've been here before, maybe a little differently, right? The Mark Twain doesn't repeat, it rhymes, but we know how to navigate this because we've seen similar situations before. And the last thing I'll say before I want to hear what Doug has to say is, I've worked with some of my clients for 15, 16, 17 years. And it's interesting, you know, we've been through a lot together, right? And I was with people yesterday and we were talking about the market. I was giving context. And when you've worked with people and had this consistency of a relationship for years, you know, they've said to me, look, Megan, we get it. We've been here with you before. We know what we're supposed to do. And I say that because I think one of the things, and I think Kirk, you and Doug would agree 100% on, is as we navigate the markets, even if it's markets that are a little different than where we've gone before, sometimes working consistently with the same advisor is incredibly helpful, right? Because, you know, you sort of have an ongoing conversation over the years. So I say this because, one, I think, you know, people in these markets tend to start making decisions about who their advisor is, right? We read all the time, you know, the biggest mistake advisors make at this point in time is not about the investing, it's about the communication. But I also think for those who are working with advisors and they're frustrated with their performance, think more about the relationship and having that consistent person in your life and seeing if they're doing the right things there versus trading them out right now just because performance is down, if that makes sense.
Yeah, totally. I love that, Megan. Doug, what about you? What are some practical advice takeaways you can learn from history?
Well, I love what Megan said about that. I mean, again, one of the things that people get too caught up in is rate of return, and it's one of the things that is unfortunately the thing that people focus on the most, but yet it's the least control that they have. Right? There is much more things that you should be focused on: prudent financial management, saving well, keeping your costs, at a reasonable level, not taking on debt. And what I mean by debt is being in debt, which is actually paying for something today. And the only way that you can actually pay for it later is through future cash flow. So a house is not debt. Okay. A mortgage is not debt. That's different. I want to clarify. That's having debt, but it's not being in debt. But I also want to go back to the history of kind of what Megan was talking about reserve funds, and knowing what you're investing in is really matters. What Megan was referring to is on September 16th, 2008, the reserve money market fund broke the buck. And again, when you think about putting your money in cash, not all cash is the same, just like not all bonds are the same, just not all stock is the same. And a lot of people get confused by that. They're like, they used to get caught up in this. Well, I make nothing on checking. I make something on savings. I made more on money market. Well, it's all the same. Well, because of that overnight lending, what happened is, if anybody's here seen the movie It's a Wonderful Life, right? He had to run into the savings and loan and give away his honeymoon money because of the unprecedented level of redemption requests that everybody made on the run onto the bank. So at the time, the Reserve Money Market Fund, which was I believe the oldest money market fund out there, only had 1.5% of its money in Lehman Brothers. And that's it. It really wasn't overly exposed. But the collapse of Lehman Brothers forced meant that the money that was sent out to get overnight interest rates all of a sudden couldn't come back. That caused a panic, which caused an It's a Wonderful Life moment where everybody ran on it and said, I want my money out. And they couldn't meet the redemption request. It actually dropped to 97 cents a share. And at that moment, all of a sudden, what you thought was your cash lost money. Okay. The only way to have your money that's truly safe is in what's called demand deposit. Demand deposit means banks have to have that on hand. You go to the bank, they have to have a certain amount of exactly the amount of money on hand that are in demand deposit accounts to redeem those. Everything else, there's no guarantee that money's available today. But that's why we have these checks and balances. And so just a little bit of history lesson there. And I think it reminded me, Megan, what you're talking about is a realtor, a gentleman owns a fairly sized brokerage in our area. And he was talking about the realtors in his office. And he's got older realtors that are in their baby boomers. It's got Gen Xers, it's got Gen Yers, and now they got Gen Z. He said the conversations are interesting. And this was probably 6 months to a year ago we had this conversation. So it's I'm sure it's gotten more interesting. He's like, we are sitting there watching these younger realtors talk about how real estate never goes down, that there will never be a dark time in the economy. It's like, we're sitting back there having gone through this as Gen X and baby boomers just look at them going, guys, we've been through it. Watch out. There's a total disconnect based on the generational experience, right? And we've had a massive bull run in a lot of areas based on low interest rates that have driven up technology and billionaires and things like that over 14 years. I mean, Kirk, what is it? About every 5 to 7, we're supposed to have a recession. We've gone
on average 7. Yeah.
7. So we've gone through 2 cycles and haven't had one. And that's an entire generation. Those people came out of college. They're now in their mid to late 30s and have never seen it. And so going back to the thought here is that this is another reason why proper diversification matters. It's another reason why people that understand your situation matters, is that things do different things at different times. And Kirk, we talk about this. Risk is never not there, right? You just don't feel it. The markets are going up. Everybody's making lots of money. There's no risk. That's not true. I've said this before. You don't wear your seatbelt as you're going through the windshield. You wear your seatbelt so that when the crash happens, you don't go through the windshield. But people get too caught up on making money and rate of return. And all of a sudden, crypto might be a good thing in the future, right? It's got a technological place here. But what happens is, as people saw it fly and fly and fly on value, they jumped in. Everybody wanted part of it because that was the place. It was all about rate of return. And if we go back over history, whatever has gone on and done well right now will have a day that it will come back to earth. Okay. And a lot of that also has a lot to do with what William Chancellor was talking about. Okay. The more that you get in that severity of how great the bull market was based on the belief of this prosperity, this new technology, how wrong that previously bullish notion turned out to be, creates a situation in which the bear market is going to be the proof that those beliefs are wrong. And how severe that's going to be will be dependent on how severe the bullish attitude was. And history has proven interest rates, time and time again, are highly correlated. You can argue whether it's causative, but highly correlated to those incredible eras of prosperity. And if you go back to, I think it was I forget the gentleman's name that started the Manhattan Company. I mean, he effectively manipulated in France, driving the economy up through low interest rates, and then turned around and did the opposite, raised interest rates, took profits, right? That's what they were talking about. Kirk, you and I were talking the other day on a podcast about the charts that were showing how long it takes for inflation to recover after it's gone up, right? And one of the things we joked about is like that data didn't really go back further than the 1970s. I thought it was really interesting that William Chancellor said, I think the only history we have of massive inflation was the 1970s. We don't have a lot of periods of history to really utilize to give any kind of guidance in direction of where to go from here. And that's a little scary too, which is why I think you always have to understand risk, even when times are good. Tune out the talking heads, which love to sell you on what's the best or the worst thing going on. And ultimately understand that the better things seem, the more we may run into a situation where there's going to be some hardship to come, and you better be prepared for it.
Yeah, no, I think it's a great perspective, Doug. I mean, I think back about, all the bubbles that have happened in the past in history in the past, few hundred years. And there's been a number of them. I mean, there've been a number in the last 20 years, for God's sakes. I mean, you had the tech bubble, then you had the housing bubble, and now we have the everything bubble. And, I think what's interesting to me is that I was thinking about this last night. I was writing something down, and it's really hard to pick the bottom, after a market sell-off. You know what's harder? Picking the top. Because the bottom, at least there's some valuation perspective, right? Things are not worth zero. Some things might be worth zero, but most things are not worth zero. So let's say like, Coca-Cola or Apple or Microsoft, take your pick, right? You could argue what they're worth, but at some point it's cheap enough, right? People are going to come in and say, it's cheap enough. I don't care if it's going to go down. I've had clients call me back in 2008 and they're like, wow, the market's down a lot. What should we do? And I was like, well, I don't know. I don't think it's over yet. And they're like, it's cheap enough. I was like, okay. I mean, that's your call. You want to get in? Great. Let's go in. Like it's cheap enough for you. That's great. There was more downside. It was like another 25% downside from there because of the 2009, it went down a lot, but then it came back. So it's like, yeah, it was a good idea. It was cheap enough. But on the upside, who the heck knows where it's expensive enough, right? It never gets expensive enough, right? If you think about any metric, you got the South Sea bubble, the Mississippi bubble, you had the tech bubble, housing. I mean, you could go down the list of the tulip bubble, all the different bubbles that have happened, and you never know where the top is. I'll give you a good example. So, a lot of people don't know this, but there's what we call the Warren Buffett indicator, which is what Warren Buffett uses to judge valuation in the markets, which is basically a comparison of total market cap to GDP. Not to get in too much of the weeds, because I don't want to put people to sleep, if they're probably coming off turkey coma, but there's, if you look at like 2000s, the metrics generally speaking are 100 is kind of average, 100 and 120% is expensive, 80 to 100 is cheap. Just for perspective, right? So the 2000 bubble, it went up to close to 150%. Wow, that's expensive, right? Well, up until recently, last year, it went up to 200%. It's so much more expensive. The values are so much higher now, or at least, beginning of the year, than they were in the tech bubble. So you could say, what's expensive? I don't know. People were complaining in 2009 that things are too expensive. And then things went up another 50% from there. So I think the thing to bring to history is perspective, right? You guys talked about how in The Office, Megan, you talked about how in The Office you get all these young bucks, and Doug talked about that with realtors. And people who have not seen this, they don't have perspective. You can read about it in a history book, and this book is lovely. If anyone wants to read history, it's awesome in giving perspective. But if you didn't feel it, if you didn't feel what it's like in 2008, you have no idea. You can read about it and say, oh, well, logically, I would do this, and intellectually, I would do that. If you didn't feel what it feels like to be afraid, to be just riddled with fear about the world ending and not knowing whether tomorrow is going to be better or worse, that's hard for a lot of people, including us, right? If you're, there were a ton of advisors that I talked to in 2008, and they were frozen in fear. They didn't know what to do. If you haven't experienced that, then you don't know how you're going to react. There's a great book called The Survivors Club where they talk about this, where they call it, what do they call it? Negative panic. So negative panic is basically, you talk about panic, you think somebody's running around like screaming, waving their hands in the air. Negative panic is you're in a plane and it's burning, and you're just sitting there looking around. It's burning, but you're frozen. You don't know what to do. That's negative panic. That's basically when people freeze, or, it's like when the military, they teach you, and not that I've been in the military, but so I've heard, they teach you basically to follow the instructions regardless of what's going on, and they beat it into you. So when gunfire happens, you just follow the directions. You don't think, because if you think you're going to freeze, you're going to be like, that's stupid. I'm not going to run in the middle of gunfire. But when they teach you is follow the directions, follow the leader, and you'll be okay. But they have to beat that into you, because naturally you're not going to do that. Your brain's going to be like, you guys are stupid. I'm not doing that. But if you consistently train yourself to act in certain environments, then you learn, and then you're not frozen with fear. So what I want to interject here is basically that for the advisors and the quote unquote experts who've been around for about, 12 years, 14 years, that have never really seen bad times. And 2020 was not bad times. That was volatility. That's not even, recession. People who haven't seen that, they have no idea how to react. And they're just going to tell you, just buy and hold, just hold for the long term. You'll be okay. If they don't have a plan in place for how to adapt to that environment, then you need to go find someone else, because this is the environment that is going to be different. And, Edward talked about this. Like, you look at all the past bubbles, like everyone, Doug and Megan just talked about this, how people think this is going to go on forever. All the young people like, oh, this is great. It's easy. I just put all my money in Bitcoin. It goes up 10,000%. And I go buy a house and a car, and, I'm only 18 years old. Like that's not reality. Like you can't expect that. And so I think what's going to happen is there's going to be a big shock with a lot of people, and they're going to be thrown for a loop because things are no longer going to be easy. When bubbles pop, things aren't easy for a while. There's this reversion to the mean concept of things go way out of whack in one direction. They tend to go way out of whack in the other direction. And eventually they find this equilibrium, but not immediately. And I think it's going to shock a lot of people. So I did want to talk a little bit about some of the fragilities in the system, because I know, Megan, you work with a lot of high net worth and ultra high net worth people. And I imagine they probably are aware of some, and they're probably looking at wealth preservation. So how do you kind of approach that? Go ahead,
Kirk, can I just want to add something really quickly on that before we switch gears is, I think one thing that you were talking about with the bubble is an old saying, that the markets can remain irrational longer than you can remain patient, right? And that's where the top is very hard to pick, because that's why he said, what did he say in it? That it isn't until the last bear gives up, it's something like that he said in the podcast. But the other thing I think is really, really pertinent to think about, because everybody can relate to this that has children, right? It's like talking to a teenager. What do they tell a teenager to go through? They say the worst kind of parenting you can do is telling your teenager, do this, do this, do this, do this, do this. Teenager can't relate. They don't experience the stress. They don't experience the pressure, and they'll either A, tune you out, or B, they'll hear it, but when they get in the situation, they are not prepared to deal with that. And that's, I think, why we have a lot of anxiety around this world right now, because as kids get out there, they just don't know how to deal with this pressure. They say some of the best parenting is to let them in a controlled environment, just like the military, right? In a controlled environment, they put them through live fire exercises to prepare them for what it's going to be really like when there's actually bullets aimed at their head. Teenagers have to go through this too. There is very little ability for the average person who is a talking head or has been around for 14 years and never seen this to have any concept. You can tell them in history books and newsletters, this is what it's going to be like. But until they get a taste of it, they cannot react in a manner that will likely turn out to be a good outcome for them when it finally appears. I just wanted to kind of add that on to what you were saying before we transition, because I think that is a lot of analogy there to the way we have to think about the way we're raising our young, because that's the same thing. They're getting into the world. We have to show them the world. We can't just tell them about it.
Thanks, Doug. Thanks for interjecting that parental advice. We're now changing our main topic from finance to parental advice. Thanks, Doug.
You never know who's listening, Kirk.
Yeah. If it's your wife, good job. So Megan, as I was saying, again, back to you with fragilities. So how do you handle that with clients?
And fragilities meaning like concerns about the marketplace?
Yeah, sorry, I'll reframe it. So yeah, I mean, I'm sure your clients, as well as most people out there, are thinking about, what are the risks now, and thinking about wealth preservation. So how do you address kind of these fragilities in the system that Edward talked about a little bit?
Yeah, I think it's twofold. One is data, right? When I think about the conversations we're having with clients and the data we're putting in front of them, it's about giving context. So one of the things that we've been showing them is the difference between the risks in the structure of the economy back in the fourth quarter of 2006 versus where we stand today, right? And when you look at, risk in consumer debt and corporate debt, right? All the different risks that caused this structural recession back then in 2008, we are not seeing those today. So it's a little bit explaining, okay, this is not a structural event going on right now. This is probably cyclical with a little bit of event-driven dip, in it because of the war in the Ukraine and the current situation in China. But the thing is, and look, this is the luxury of having money, right? When you are in these markets, opportunity pops up, right? So from an estate planning standpoint, up until a few months ago, because rates have gotten too high, when we've had the markets pull back, we've been taking advantage of estate planning techniques like grantor retained annuity trusts, or GRATs, which are a way to pass appreciation to your children, without using up any of your unified credit, right? So that's been an estate planning opportunity that's been going on. Also, transferring assets at a lower valuation has also been a tool that we've been using during this down period. In terms of investing, I think the thing is most high net worth, ultra high net worth individuals have really started to build out, the private portion of their portfolio. The public markets over the last 25 years have shrunk. The private markets are obviously a really interesting investment proposition, but keep in mind the challenge is there's also a lot of crap in the private markets. So getting, access to the top tier opportunity set is really important, and building out a strategy to get access to it. So this year, more and more of our clients went into things like private credit, right? Mezzanine debt, right? To sort of pick up additional asset classes in their portfolio, private real estate. We anticipate next year, and one of the things we saw this year was that there were a lot of capital calls that we had to deploy because clearly the managers that they're investing in are seeing opportunities. So I think for high net worth, ultra high net worth, this is just a time period of opportunities. It's just getting an understanding of what's the opportunity set in front of them and how do they maximize it. And I think that that's a lesson that all of us can take advantage of, right? It's the people who don't panic who often do best in challenging times. And so staying calm, thinking through different ideas. And I'm sure, Kirk, Doug, you have clients that you're going to with different ideas right now, as well as they're coming to you with what they're hearing. And these are the value, that this is where value is provided by having the right advisor, whether it's an investment advisor, a CPA, estate planner. This is where you really got to kick the can around to make sure you don't miss anything. Because when I look back on the 08-09 crisis, I was not in a position to do it, but I wish I had cash. I would have bought houses. And I remember I was working with a bunch of clients at companies all over, but one company I worked with like 8 of the executives, and the CFO wrote me and he had a list of their names and he said, you know what all these people have done in the past year? And this is probably like April of 09. He's like, they all bought a second home and they all work with you. And that was one of the things, like I kept looking at my clients' money during those time periods and figuring out what would I do if I had that money? And so, this is where you really can sort of have a little fun and find opportunities that you get rewarded for over the years.
Yeah, I think that's actually a wonderful way to look at it, is thinking about like, what if this is my money? What would I do with it as advisors? And one thing I come across a lot when I talk to people who are kind of interested in switching advisors is, I talk to them and they're like, oh, I'm like, oh, so what's your advisor suggestion you do now? They're like, nothing. They're like, well, what do you want to do? Like, well, I've got all these ideas. I'm like, why are you bringing them ideas? Like, why are you paying them? Like, they're supposed to be bringing you ideas. They're supposed to be advising you. And I just see it nonstop of just advisors just don't do anything. They just put money in a bunch of funds and they forget about it. And the client's like, what are we doing? And, there's no perspective. There's no changing. There's no adaptability. It's just like Megan said, like, hey, like, what would I do right now? Like, there's so much, like 2008, 9, 10, wonderful time. I mean, we saw so many opportunities. We didn't have enough money to capitalize on them all. But, like now you think about it like, oh, I'd love to have those 2008 opportunities because there's so much cash sitting around that, at some point we'll see them again. Like it's inevitable. Like you could argue whether we're going to go into recession or not. I'm not going to debate that here, but I could say that based on the valuations we've seen, it's inevitable we're going to see much, much lower valuations, which
and
is
I want to
awesome.
add something to what you're saying there, Kirk, because I think it's important. I think when you go to work with an advisor, one of the things that initial conversations you should have is, what is your process? What is your due diligence, right? How do you go into the investment universe and pick this over that, right? How do you decide how you're going to deploy into these funds? And why those questions are important and by the way, you can bring it up anytime in the relationship with the advisor, but obviously the starting point is the best point to do it if the advisor doesn't share it. But why that's important is, sometimes during these challenging markets, you don't want to be making changes, right? But I will tell you, we are talking to all of our managers constantly. And so a lot of times when I'm going to meetings, what I'm saying to clients is, look, clearly we're down here. Clearly this is a challenging marketplace. But when we've talked to XYZ SMA or this, mutual fund or this ETF fund. This is what's going on in the underlying fund. This is what they're seeing. This is how they're positioning. And I'll give you a really quick example. When Russia in January of 2021, which feels like not that long ago, but it's almost 2 years ago, when, January 6th happened and the Russians started to align troops in greater number on the border of Ukraine. A lot of emerging market managers who focus on having what we call boots on the ground. We say that all the time, but they had people on the ground and they had been watching the Russian banks accruing reserves, right? And they saw all this. And so they started to take steps to pare back the risk and reallocate, take money out of Russia exposure and reallocate to other places where they felt that if a war was to happen, we would have to go seek other things like fertilizer, right? Who knew Russia and Ukraine handle a lot of fertilizer for us, or soybeans, right? And so they started to turn their attention to other countries. And so I find with clients, understanding what the managers are seeing on the ground, understanding the decision-making process with the managers also helps in moments like we're in today.
Yeah, that's great. So Doug, what are some of your thoughts? How would you handle or talk to clients about kind of fragilities in the system?
Well, again, like I said before, I think, one of the best ways to approach any of this is to be proactive, right? If you're putting your money in a lot of different places at all times and in all cycles, you're going to have the opportunity to weather these kind of circumstances. And I'm not just talking about bonds versus stocks, which 90% of people, that's what they basically have is their 401k, and they're trying to allocate that between equities and fixed income, and yay, that's their portfolio. I'm talking about having liquidity, having real access to capital. I mean, like you mentioned, it is a lot easier to try to figure out how to truly buy the dip. And I'm not talking about the meme buy the dip, right? Oh, market fell by a couple percent. Let's buy it. That's dollar cost averaging. I'm talking about watching everything begin to implode, watching the economy lose steam, watching the market react to that, and seeing a significant devaluation of the markets. Whether in 2008, 2009, whether you hit the bottom or not, wherever you entered, you were fine. It's okay to lose a little froth off the top, as long as you're not riding the thing down to the bottom. Okay. So, manage that, don't be focused on returns necessarily. If consistent returns, compounding interest, using things that have compounding interest. I show clients this every day. A 5% compounding interest over 20 years can outperform speculative returns, depending on what those 20 years provide. Okay. So it's good to have some things that are kind of boring and smooth and steady. I like adding things that have index capabilities that are tied to markets, but you can't go down. You can only go up. Some things like there's different kinds of notes that are out there that are, index based. There's, if you're a high tax bracket and you need places to park, look for tax strategy. People talk about fees every day. The biggest fee you'll ever pay is taxes. Okay. It is. It's you lose 20, 30, 40% of your wealth to taxes. Be concerned about that. I like where you can protect your income, When the end of the day, what matters is people want money to live off of. Okay. I have things I need to spend today, but also in the future. The biggest battle that people will be facing is the battle between the insatiable wants of today versus what their needs will be in the future, and prepare for that. Saving steadily is your number one rate of return right there, right? It is a rate of return. $5,000 added into savings is $5,000 of growth. Okay. Now you want your money to begin to work for you over time, but listen, there's no such thing as good products. There's no such thing as bad products. There's just things that are right for you. So I like the right kind of private placements. We're talking about a market that is significantly higher in the private space than the public markets have access to. But the majority of transactions, trillions of dollars of transactions in public space, because it's easier access. So for the right people, private placement money might be a good place to go, but that's illiquid. So again, going back to making sure you still have access to capital. Permanent life insurance can be a great play. Significant number of millionaires, politicians, wealthy, use it as a strategy to put money where they'll never pay taxes again. And they can get steady, consistent returns. Annuities, precious metals, commodities. You mentioned Ukraine. Who thought that 95% of the world's wheat comes out of Eastern Europe? That's kind of scary. All the gluten intolerance talk we talk about. If you're gluten intolerant, it's hard to find foods that aren't based on wheat, right? It is the number one source of food on the planet. So, commodities are huge. Oil, it falls into that. Wheat falls into that. I mean, again, the things that we need, things that are highly capitalized, that tend to be more consistent. They might be expensive and less volatile during those great, wonderful low interest times, look really good right now when it's harder to buy the capital technology that you need to be able to break ground, right? The companies that have it carry a lot of expensive equipment. But right now, that expensive equipment, when you already own it, looks really good as a company versus a company that's trying to now figure out how to capitalize. I like, again, your traditional retirement, just keep saving, doing things. I think those are really important. But I also want to segue to something, another historical thing I think is interesting. We don't like to get political on this, so I'm going to go bipartisan on this. Go back to the 70s when we were facing some of the most difficult times that we have seen as an economy since the American economy really started keeping track of that. There were two sacrificial lambs that occurred in the 1970s. The first started with Gerald Ford. Right? Gerald Ford stuck his neck out and pardoned Richard Nixon to avoid thrusting the U.S. politics, the U.S. economy, the U.S. focus into a drag-out fight over the impeachment of Nixon. Okay, again, agree with it or not, that's why he was a one-term president. A lot of people held that against him, on top of the fact that the economy was terrible in the 70s. Again, people look back at Carter as a failed presidency, one-term presidency. But what did William Chancellor talk about? I mean, in a way, he was kind of a sacrificial lamb. Some of the decisions that he made selflessly to try to fight what was going on with the inflation and stagflation in the economy. Now, you can certainly argue whether or not they were the right decisions, but it effectively cost him his presidency. He was done in one term. The problem I think we have today in this world of social media and the world of people that are just willing to say, I want to hear what you have to say, but as soon as you say it, I'm going to use that to eviscerate you, is that I just wonder if there is anyone in politics anymore that would be willing to make those kind of decisions, even if they're right or wrong, knowing that controversially it could end their career. I think that's one of the bigger issues we have. And William Chancellor talks about a lot of the decisions that have been made in terms of raising interest rates, lowering interest rates. He even believes that they're not going to do what they need to do in the current environment to raise interest rates where it actually needs to be to fight inflation, because too many people are concerned about their political career. And I think that is going to lead us to something that we need to be preparing for right now, is a longer term pain than we might have otherwise faced. So again, be prepared with the stock market, be prepared by diversifying. And by the way, keep cash around to some degree, because as Warren Buffett says, it'll give you options tomorrow.
Yeah, that's great advice, Doug. And it's funny, you said something about politics, and I think we have a serious lack of leadership in politics and society, actually. It's not just politics. Politics is a reflection of us. Since we elect them. And somebody made this comment a while ago. It said, you don't get the politicians you want, you get the politicians you deserve. And nobody wants to hear that, because it makes you feel like, well, what am I, an a-hole? Because these people are. But, at the end of the day, I think there's a lot of truth to that. And I think if everyone kind of reflects on how that impacts, you might even think about politics differently. But as we kind of wrap up here, in the interest of time, Megan, final thoughts from you. Where can people find more about you?
Yeah, I mean, first of all, I think to really be a strong investor, it's always good to read lots of different things. I felt that, one of the books over the past, I guess, 15 years, Too Big to Fail, is a great book to read to start to understand some of this. But I think, as we continue to deal with volatility, look for opportunities. The opportunity set is changing, but it doesn't mean it's not there. As I said, cash is back as an asset class, fixed income's paying fixed income. Stocks are starting to be reasonably valued when you look at PE ratios. So there's a lot of opportunity in the marketplace, but it's those who understand their risk tolerance and keep their head who do best in these types of markets. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
And thanks for coming on, Megan. And Doug, final thoughts from you.
Yeah, I think I like what you were just talking about there. I think it's a great book, Too Big to Fail. And I think that another thing that's really interesting about this economy and kind of looking forward into what is going to come is be prepared, keep liquidity, keep access to capital. That doesn't mean it doesn't have to be invested, but make sure that you've got access to it to certain amounts that are not going to be subject to the volatility that's there. I also want to remind people volatility and risk are not the same. Now, they can both hit at the same time. Volatility can be a great thing. And William Chancellor talked about that. He talked about the volatility, and actually it was Kirk, I think, that you addressed that. It's like, we thought it was going to be risk. It ended up being volatility. Well, risk is always a part of volatility. I'm sorry, volatility can have risk, right? So when you have risk, you're definitely getting volatility. But the issue is, if volatility can also mean getting 10, 20% on the upside. Volatility is just movement. Okay. So we're going to continue to face volatility, but I think also we have not experienced risk. We've not been in a car crash. We've been driving for 14 straight years with that seatbelt on, and we've gotten complacent. We've gotten to the point in which we think that if there's a chance that, look how good of a driver I am. I've never been in a wreck. I guess I don't need this anymore. Maybe we should start taking seatbelts out of the car. This is why we wear them. Always wear your seatbelt when it comes to your investments. Diversify, put things in different places that work differently. As I always say, if you don't like something about what your money's doing, you're probably not diversified. And where you can find more about us today, I'm going to talk to you about one of our companies. It's Automatic Business Method. Automaticbusinessmethod.com. Go out and check about it. It's the secret to skyrocketing your business. If you're a business owner, the Automatic Business Method freedom process will solve you time problems, team problems, and money problems without expensive consultants or complicated tech in just 9 steps. Again, as things get more volatile and harder in this economy, it's going to be harder for individuals as well as businesses. Make sure that your business inefficiencies don't rear their head. Find out how to make your business more seamless and more profitable right now, so that no matter what happens, your business will thrive with or without you.
Great. Well, thanks again for joining us, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.